But you have just entered the other 1%. We're going to be discussing the Iron Condor options trading strategy. This has a 65% success rate. You can succeed with it. I've succeeded with it. Let's jump right into it. All right, I've just pulled up the chart for ON Semiconductors. We want to find a particular chart that is trading pretty flat. The key to the Iron Condor is actually having the movement of the price of an underlying stock staying within a certain parameter, not going too high, not going too low. What is an Iron Condor? Well, you're going to set up two different credit spreads. On one side, you're going to have the put credit spread, and on the other side, you're going to have the call credit spread, and this is going to give you the Iron Condor. You can see here specifically how it's going to play out. If you go too low, you're going to lose. If you go too high, you're going to lose. But most of the time, you're going to want to stay right in the middle, and that's going to be your maximum profit for the trade. All right, so here we have a blank trade on ON Semiconductors, expiring October 18th, which gives us about 49 days left until expiration. Most people will just set up a trade where they buy a call right at the money at about $75. It's currently trading at 77. If I slide the time bar and pass many days, you can actually see where your position starts to lose. If you stay in the same realm on the same price, you're going to end up being down. This particular trade requires you to actually gain a lot of position in order to be successful. Forget all that. We're going to trade the Iron Condor, where actually time is on your side. Check it out. All right, so first of all, we're going to start off with buying a put. And we're going to buy this put specifically at $65. Then we're going to sell a put, and this put we're going to sell at $70. That makes up the put side of our credit spread. Now let's move over to the call side. On the call side, we're going to sell a call at $85, and then we're going to buy a call at $90. Now, here's our trade setup. This actually indicates that we have an Iron Condor right there. The key to this strategy is staying within a certain parameter. At the end of expiration, if we slide the time all the way over, as long as we stay between 68 and 87, we're going to be profitable in this trade. If we set the time back to current and we move the scale forward in time, you can actually see how our window of profitability begins to grow. In this trade, unlike in the long call, you actually benefit as time passes. But most importantly, this trade is even more advantageous when implied volatility goes down. So when there's an underlying stock that is high in implied volatility and you expect that that's going to decline, you're going to benefit tremendously from this trade. Watch as the profitability cone expands and gets taller as implied volatility goes down. Now that's a beautiful thing. Key takeaways. Iron Condors allow you to benefit from time passing by and when implied volatility goes down. You want to stay within that window of opportunity. You don't want the stock to go too far high or too far low in trading price. So stick around. We're going to talk more about these trades and other basic strategies that can provide you with passive income without having to do any work. Just let the time pass and you collect premium. Check out our other video talking about NVIDIA earnings trades that you could have done the other day. You probably missed it, but you're not going to miss it next time. Subscribe, hit the little ding bell. You know what to do. We'll be back here next time on the other 1%.